folks. Today we're going to start with chapter 1 of Audit for CA Inter. My focus is going to be 100% on mugging up, okay? Only mugging up. Maybe 50, remaining, another 50%. I'll try to explain, okay? But definitely we're going to be grasping the words, the keywords, a little bit of understanding, and how we're going to present it in our answers. And this material that I'm going to be using is that of Edu 91, which is a really great institute if you want to get yourself enrolled in it. Next, let's start off without any other delay. Okay, so basically, what is an audit? Audit is an independent examination, right, of the financial statements, of the financial information, right? It's an independent examination of the financial information of any entity, whether profit oriented or not, irrespective of size or legal form. Okay, so it would be really helpful if you tell it with me. Okay, so audit is an independent examination of the financial information of any entity, whether profit oriented or not, irrespective of size or legal form. And when such examination is conducted with an opinion with a view to express an opinion. Okay, let's start from the top again. Okay, so here, audit is an independent examination of the financial information of an entity, whether profit oriented or not, irrespective of the size or legal form, right? When such examination is conducted with a view to express an opinion. Okay, so that is pretty simple, right? Now we will dive into the meanings of each word over here. Independent, over here, independent, obviously we will learn a bit more about what independent really means in the next chapter, but this is just an overview, if you can, overview of what is yet to come. Okay, so independent means that the judgment of the person is not subordinate to the wishes or direction of any other person, right? So the judgment of a person is not subordinate to the wishes or directions of another person. Pretty simple, right? So you should not get influenced by any other person's judgment, right? So his judgment should not be influenced, and that is what independent means here. Okay, next, moving on to what does financial information mean. Financial information is the information, it is in the information expressed in financial terms in relation to a particular entity from its accounting system about its economic events. Okay, information expressed in financial terms in relation to particular entity from its accounting system about its economic events and conditions. Okay, now we learned about what is the meaning of independent. We learned what is the meaning of financial information. Now let us dive into what that financial information also includes. So the financial information includes the financial statements. So financial statement, what is a financial statement? Financial statement is a structured representation of the financial information. It includes all related notes, communicates the financial statements communicates entities, resources and obligations. Okay, and financial statements are prepared as per financial reporting framework. Now what is financial reporting framework? Financial reporting framework is the guidelines as per which the financial statements records the amount, the classification, presentation and disclosure. Okay, it gives guidelines as to amount, classification, presentation and disclosure. Now amount meaning the amount that is recognized, right? and the classification, whether it is an income or expense or an asset or a liability as such, right? Presentation and disclosure of any other information as per accounting standards or whichever other guidelines that company is supposed to follow, right? Next, now what is applicable financial reporting framework? And AFRF is the FRF adopted by the entity for preparation and presentation of financial statements, or else it is also for the sake of this revision I'll be calling it as PPFS. So the FRF adopted by the entity for PPFS. Okay, right? Just simple. Let's come from the top again. So what is an audit? Audit is an independent examination of the financial information of an entity, whether profit oriented or not, irrespective of size or legal form, when such an examination is conducted with a view to express an opinion. Okay, so let's tell it again. Independent examination of the financial information of any entity, whether profit oriented or not, irrespective of size or legal form, when such examination is conducted with a view to express an opinion. Okay, next, right, of this financial information that we're talking about here, this financial information, this information is historical financial information, right? So based on what is already prepared, what has already occurred, right? It is not prospective or it is not future financial information, it is historical financial information, right? Okay, next, over here, let's move on to the next part. Now here the opinion is given on an engagement. Now what is an engagement? Engagement is, here we're talking about the assurance engagement. Okay, so this is actually there in the ICI material, right? So it is an assurance engagement. What is an assurance engagement? An engagement in which when a practitioner obtains sufficient and appropriate evidence in order to express a conclusion designed to enhance the degree of confidence in the intended user other than the responsible party. Okay, so here a practitioner obtains sufficient and appropriate evidence for what? For expressing a conclusion, and that conclusion is designed to enhance the degree of confidence, enhance the degree of confidence of the intended user other than the responsible party. Who is the responsible party? Responsible party is the person who is responsible for preparation and presentation of financial statements. Clear? So again, what is an assurance engagement? An engagement when a practitioner obtains sufficient and appropriate evidence. When a practitioner obtains sufficient and appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party. Okay, so about what does he increase the degree of confidence in? About the outcome of the evaluation or measurement of a subject matter against a criteria. So here you can find out there's three elements of actually more than 3 elements, but there are 3 parties over here. One is obviously the practitioner, and the other person is the intended user and the responsible party, right? So it's very simple. What it's trying to say is, here the responsible party prepares the subject matter and gives it to the intended user. The intended user appoints a practitioner. He appoints a practitioner who analyzes the subject matter, who collects sufficient and appropriate evidence, right? And he expresses his opinion to the intended user. Okay, about what again? About the accuracy, about the outcome of the evaluation or measurement of the subject matter against a criteria. Against a criteria as in whether it is prepared as per FRF, or it could be whether it is reasonably, in case of prospective financial information, whether all the assumptions are reasonable, so that criteria whichever he follows, right? Let's try to say that, let's try to repeat what this assurance engagement is, because it could very well come in the exam and we don't want to get caught off guard, right? So assurance engagement is an engagement when a practitioner obtains sufficient and appropriate evidence in order to express a conclusion designed to enhance the confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of the subject matter against a criteria. Okay, let's tell it again. When a practitioner obtains sufficient and appropriate evidence with a view in order to express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party, okay, about the outcome of the evaluation or measurement of a subject matter against a criteria. Okay, let's try telling it again. When a practitioner, okay, an engagement when a practitioner obtains sufficient and appropriate evidence in order to express a conclusion designed to enhance the confidence of the intended user other than the responsible party about the outcome of an evaluation or measurement of a subject matter against a criteria. Okay, I think that should be sufficient. Let's tell it one more time. Okay, assurance engagement is an engagement when a practitioner obtains sufficient and appropriate evidence in order to express a conclusion with a conclusion designed to enhance the confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of a subject matter against a criteria. Okay, let's tell it one more time, just good measure. When a practitioner obtains sufficient and appropriate evidence in order to express an opinion, in order to express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of a subject matter against a criteria. Okay, when a practitioner obtains sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of a subject matter against a criteria. Okay, I think that should be good enough, right? Just move on. Next. Okay, so what are the elements of an assurance engagement, right? Basically, you can how if this comes in the exam, I would suggest writing this first as the base. Like start off with the meaning of what an assurance engagement is, and then move on towards the elements, which is basically parts of the definition itself, right? So here the parties, the subject matter, criteria, sufficient and appropriate evidence, and then a written conclusion. So these are the elements of an assurance engagement, right? So here the parties are obviously a practitioner, and then here the intended user and the responsible party. The subject matter could be anything, the financial statements, or it could be any certificate, whatever, basically giving assurance that whatever is in that document is moderately or reasonably correct, right? And here against the criteria, it is checked against a criteria. So here these two always come together. So the subject matter is always checked against a criteria. And how is it evaluated? By obtaining sufficient and appropriate evidence, and he gives a written conclusion about the subject matter. Okay, let's just recap one last time. Okay, so an assurance engagement is an engagement when a practitioner obtains sufficient and appropriate evidence in order to express a conclusion designed to enhance the confidence of the intended user other than the responsible party about the outcome of an evaluation or measurement of a subject matter against a criteria. Okay, now what are the elements of an assurance engagement? Firstly, it is the parties. The parties, which are, there are three parties. They are the practitioner, the responsible party, and the intended user. Okay, next one is the subject matter, and third one is the criteria. Fourth one is sufficient and appropriate evidence, and lastly the written conclusion that is given by the practitioner. Okay, I think that should be very simple, right? And here there's another recap of what an audit is. Audit is an, sorry about that, that's fine. Here, audit is an independent examination of the financial information. What is the financial information that they're talking about here? It is the historical financial information that is also called as the financial statement. What are financial statements again? Financial statements are the financial information. The financial information is when it is presented in a structured manner, or the structured representation of the financial information, and includes all related notes. Okay, it communicates the entities, resources, and obligation, and it is prepared as per financial reporting framework, right? So again, as per here, audit is an independent examination of the financial information of any entity, whether profit oriented or not, irrespective of size or legal form, and its objective is to express an opinion, right? Very simple. That is yes, let us actually go through the text that is given here so that we have a bit of subject matter or betterment of the language in which we write the answer. Let me just go through this. Okay. Audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of size or legal form, and when such an examination is conducted with a view to expressing an opinion thereon. Okay, very simple. Let's move on. Okay. Here, again, as I had explained, independence here means the judgment of a person is not subordinate to the wishes or direction of another person who might have engaged him, right? Next, audit applies to various entities. Okay, there could be a question on this also, because I've seen it in the question bank, right? So they say that it is not applicable to a non-profitable entity, which is wrong. It applies to any entity, right, regardless of size or legal form. The purpose of the audit is to express an opinion on the financial statements. Now, historical financial information. What is historical financial? It is information expressed in financial terms of an entity about its economic events and circumstances. Okay. Now, what is financial statements again? Financial statements are structured representation of the historical financial information, related notes, and it communicates the entities, resources, and obligations. Okay. And these financial statements are prepared as per financial reporting framework. Perfect. Okay, done. Next, we'll move on to the first essay in this series. Okay, so the first essay is the essay 200, which is what I've been taught is Uya Kasa. Okay, which is overall objectives of an independent auditor and conduct of an audit as per standards of auditing. Okay, so very simple. Here, right, standards essay 200, overall objective of an independent auditor and conduct of an audit as per standards of auditing, right? Next, what does it say? What does essay 200 say? It says obtain reasonable assurance that financial statements are free from misstatement, whether due to fraud or error. Okay, very simple. It is to obtain reasonable assurance. You remember, this is the keyword. Obtain reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. Okay, so let us call it again. Obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. Okay, next. This is the first thing that it says. The second thing that it says is, and his objective is also to express an opinion on the financial statements that it is prepared as per applicable financial reporting framework. Okay, and lastly, third objective is to report on the financial statements and communicate as required by essays. Okay, so there are other essays which require communication of the auditor and whatever he has based on whatever he has found in his examination, right? So let's just go through it again, right? I think it's written over here in a very simplified form. Okay, just to obtain a reasonable assurance, right? Reasonable assurance that the financial statements are prepared as per financial reporting framework, and to express an opinion that the financial statements are free from material misstatement, right? And to report and communicate on the financial statements, right? Let's just go through that again, right? Now it is to obtain a reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error, and then express an opinion on the financial statement that the financial statements are prepared as per the applicable financial reporting framework, and then report on the financial statements and communicate as required by the essays. Now let us dive into the words one by one. Okay, so here, reasonable assurance. Reasonable assurance means it is a high level of assurity, but it is not absolute. Okay, it provides a high level of assurance, but it is not absolute. Okay, so again, financial statements. What are financial statements as per our last discussion a few minutes ago? Financial statements are the financial information or the structured representation of the financial information. It communicates the entities. Rights and obligation. It is prepared as per financial reporting framework. Okay, perfect. Next, we'll move on to free from material misstatement. What does material misstatement mean? We'll just look into that. Now, material misstatement means it is considered material if it can influence the economic decision or judgment of the users of the information. So let us tell it again. Material misstatement. A misstatement is considered material if it can influence the economic decision or judgment of the users of the information. Right? Now, next. Now, what does misstatement mean? Now we found out what material means. Now let us look at what misstatement means. Misstatement is the difference in amount, classification, presentation, and disclosure as required compared to the actual amount, classification, presentation, or disclosure. Accounting, sorry, not amount, accounting. Right? Accounting of amounts itself, basically. So you can interchange it, but let's just look at the material and then we'll get to know, right? So here, right, so basically what is the misstatement is if there is a difference between what is required and what is actually presented. So that would cause a misstatement, which is pretty simple, right? Let's move on to the next one, whether due to fraud or error. Okay, this is now here fraud is intentional, right? It is basically intentional, right? And detection is very hard. Detection is hard. However, in error, it is an unintentional cause, and its detection is not hard. Okay, if there is an error, reasonably easy. Okay, it's not that it is completely easy, or you can tell it is reasonably not hard, basically, right? and the risk of not detecting is very low. Here risk of detecting is high, because would have the people who have committed the fraud would have taken a lot of measures uh, to hide those misstatements or inconsistencies in the financial statements. So because there is a willful effort that is put into hiding the evidence or hiding those documents, the risk of detecting is very high. Sorry, the risk of not detecting is very high. Okay, when it comes to error, it is unintentional. Detection is fairly and reasonably easy, and risk of not detecting is quite low. Okay, as there is no willful effort towards hiding such uh, information or hiding such evidence, right? So now here, how would one find uh, errors? That is obviously through the audit procedures, right? So now I'll just ask a question out of nowhere. Who does now, even though an auditor applies his audit procedures, can he miss an error? Can he miss an error? Yes, of course, because can audit risk cannot be reduced to zero. Okay, it can never be zero. So obviously there are certain cases where it can slip, uh, even the process of audit, right? Next, moving on. Let's just start from the top here. Now that we've understood every keyword over here, right? So it is uh, what is SA 200? SA 200 is overall objectives of an independent auditor and conduct of audit as per standards of auditing, right? Moving on, we'll just see what is there in SA 200. It is to obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. Let's try again. The first objective is to obtain reasonable assurance that financial statements are prepared as per the sorry scratch that. The first objective is to obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. Okay, obtain reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. Okay, and secondly, express an opinion that the financial statements are prepared as per applicable financial reporting framework. And lastly, report on the financial statements and communicate as per required essays. Okay, very simple, right? So first it is obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error, right? And second objective is to express an opinion that financial statements are prepared as per applicable financial reporting framework. And lastly is to report on the financial statements and communicate as required by essays. Okay, perfect. Let's dive into what the material has for us over here. Okay, so we just I think we missed this while we were moving on to the objectives. We just cover this and then we'll go to that. Okay, so what is an engagement? What is an assurance engagement? It is an engagement in which a practitioner obtains sufficient and appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended user other than the responsible party about the outcome of the evaluation or measurement of a subject matter against the criteria. Okay, right. So next one is, it is giving assurance. What does giving assurance mean? It means offering an opinion about the specific information, so that the user to the information are able to make confident decisions, knowing that the risk of information being incorrect is reduced. Here it is reduced. They might ask correct or incorrect, or an MCQ where they replace this word reduced by, let's say, eliminated, right? We should remember that in any assurance engagement there is no absolute assurance, right? There's no absolute assurance. There's only a reasonable assurance, right? There's a reasonable assurance, right? So let us remember that. Okay, let's just tell it once for good measure again. Okay. An engagement in which a practitioner obtains sufficient and appropriate evidence in order to express a conclusion. It is designed to enhance the confidence of the intended users other than the responsible party about the outcome of an evaluation or measurement of a subject matter against a criteria. Okay, next. What does giving assurance mean? Giving assurance means offering an opinion about specific information so that the users of the financial statements can take confident decisions, knowing that the risk of the information being incorrect is reduced. The keyword is reduced. Okay, next we'll move on. Obviously the three here the elements again, there are 5 elements. What were the 5 elements, if you can recall those 5 elements again? So firstly it was the parties, right? So there are 3 parties, right? Next is the subject matter, and then the evidence, and then the conclusion. Sure, we're missing something. Conclusions and the criteria, right? So the subject matter and criteria move hand in hand. Okay, so what are the 5 elements again? 5 elements are the parties that are involved. There are the 3 parties that are involved, and then the subject matter that is checked against the criteria. How is this assurance given? Through obtaining sufficient and appropriate evidence, and lastly the written conclusion. Okay, next we'll move on. Okay, so here we just dive into so that we get a bit of subject matter to write during the exams, right? So first, it is a 3-party relationship, right? So between a practitioner, responsible party, and an intended user. Okay, so who's the practitioner? Practitioner is the person who's providing the assurance. Okay, so the term practitioner is broader than the assurance, broader than the auditor, meaning this is the practitioner definition, and in practitioner small definition of an auditor is also included. So auditor is included in practitioner, right? Next, audit is related to historical financial information, whereas practitioner may provide assurance not necessarily related to historical financial information, right? So here assurance engagement, okay, let me just explain a bit before, it will come in the future, like it will come few topics below, but I just explained over here. So here the kind of services that are given basically can be defined into 2 parts. One is the assurance engagements and the other engagements. Here assurance engagements are also based on 2 parts. One is historical financial information, and others again non-historical financial. Here you can conduct an audit or a review. Okay, here it's only called as an assurance engagement. Okay, and lastly related services, based on whatever service an auditor or a practitioner provides based on any agreement that is entered into. Okay, simple. Next, now where was I? So obviously the practitioner is the person who provides the assurance. Practitioner is broader than the auditor. Audit is related to historical financial information, whereas practitioner may provide assurance on related not necessarily related to historical financial information, right? Next, the responsible party is the party who is responsible for preparation of subject matter. So whatever subject matter is being checked by the practitioner is prepared by the responsible party. Okay, the intended users are the persons for whom an assurance report is being prepared. So the practitioner prepares a report for the intended users. Okay, so these persons may use the report to make decisions. Fair and simple. Next, the subject matter. It is the information that is examined by the practitioner. Here financial information, in case of an audit, it is always historical financial information, meaning it's not prospective, it is not future oriented. It is only what has happened is what the auditor uh, examines, right? And but however, assurance engagement can be of historical financial information or prospective financial information. Okay. So next, who's responsible for the management or those charged with governance, or also known as TCWG. We'll learn about TCWG later in the video. Right. Next, suitable criteria. Suitable criteria is the benchmarks that are used to evaluate matters like standards, guidance, laws and rules, regulation. Right. So here, in case of an audit, we check it against the accounting standards. Right. So the suitable criteria is based on it varies over different entities and different organizations, right? Next, sufficient and appropriate audit evidence. Here, sufficient means quantity, appropriate means the quality of the evidence. Okay, so basically that's all that you have to remember in this. Just leave it on the screen, or you can pause to go through this on your own. Okay, let me just move ahead. Next, the written assurance. Obviously, the written conclusion is the final outcome of the assurance engagement. It contains the conclusion that conveys the assurance about the subject matter. Next, as I told earlier, a misstatement is the difference between the amount, classification, presentation, and disclosure as reported in of a financial statement item, and the amount, classification, presentation, disclosure that is required for the item in accordance with the AFRF or the applicable financial reporting framework. So obviously I just simple it down over here. Difference between amount, classification, presentation and disclosure of a reported item on the financial statement, and the amount, classification, presentation, disclosure required by the required for the item, basically required for that particular item as per FRF, as per applicable financial reporting framework. Okay, let's move. Okay, this I think we've discussed that misstatements can arise due to fraud or error, right? Very simple. Let's move on. When misstatement is considered as material, obviously when it could be reasonably expected to influence the economic decisions of the users taken on the basis of the financial statements. So here misstatements could be omissions. Okay, misstatements also include the omissions if they individually or in aggregate, right? So individually or aggregate, right, are expected to influence, or could be reasonably expected to influence the economic decisions. Okay, when it could be reasonably expected to influence the decisions of the economic decisions of the users. Okay, so misstatements include omissions, right? They are considered to be material if individually or in aggregate, right? They could be reasonably expected to influence what? The economic decisions of the users. Okay, next, moving on. Meaning of applicable financial reporting framework. Okay, here the framework that is adopted in the PPFS that is acceptable in the view of the nature of the entity and the objective of the financial statements. Okay, so it is the framework that is adopted in the PPFS which is acceptable in the view of the nature of the entity and objective of the financial statements. Okay, very simple. Next, so here we'll move on to the types of opinion. Okay, so here the types of opinion can be either unmodified or modified. Okay, so unmodified means a clean or an unqualified opinion, meaning that the auditor has the auditor is providing reasonable assurance that the financial statements are free from material misstatement. Okay, so if there is a misstatement, he will provide a modified opinion. Okay, so if there is material misstatement, he will give a modified opinion. If there is no material misstatement, then he will give an unmodified opinion or an unqualified opinion. Okay, so here when it comes to modified opinion, there are 4 types. Okay, firstly, there is material misstatement. Okay, there is material misstatement and it is pervasive. We'll get to the meaning of pervasive a bit later into the video. But what we have to remember is pervasive means whether it has the effect of influencing the entire financial statement, or if it is forming part of the majority of the financial statements, right? So whether it can, let's just dive into the meaning of pervasive first. Okay, so here pervasive is used to, the term pervasive, it is used to describe the effect of misstatement on the financial statements. Okay, so material misstatement is deemed to be pervasive when it is obviously dependent on the auditor's judgment. Okay, so what is auditor's judgment dependent on? His training, knowledge and experience, right? So whether material misstatement is pervasive or not is dependent on the auditor's judgment. Okay, but they have given what factors he is required to consider before stating that such material misstatement is pervasive or not. Is it should not be confined to a specific element. Okay, so it is not confined to a specific, okay, like it's only like one item. So if it is only one item, obviously it is not pervasive. However, it can, even if it is confined to one item and it forms a massive part of the financial statements, it can still be considered pervasive, right? And disclosures, when it comes to disclosure, dependent whether a disclosure is pervasive or not, it is dependent on whether it is fundamental for the understanding of the financial statements. Okay, let us just recap this. Right? What is pervasive? Pervasive means, pervasiveness explains the degree of or the effect of misstatement, right? It provides the effect of misstatement on the financial statements. Fair and simple. Next, now whether a material misstatement is pervasive or not is dependent on what? Is dependent on the auditor's judgment. Okay, auditors, it's also called as auditor's professional judgment. Okay, where is this auditor's professional judgment? How does he get this professional judgment? Through his technical knowledge and experience, right? Through his training, knowledge and experience, right? And lastly, so the factors that are need to be considered before telling whether something is pervasive or not is whether so basically there are 3 things, right? Such item or that misstatement, basically that material misstatement should not be confined to a single item, right? Should not be confined to a single item, right? However, we know that it can still be pervasive if it is a single item, even though it is a single item, if it forms the substantial part, right, of the financial statement. If it forms substantial part of the financial statement, it will be considered as pervasive. Now when it comes to disclosures, a disclosure is considered to be pervasive depending on whether such disclosure is fundamental for the understanding of the financial statements. Clear? Okay, we'll move on. Now we understood what pervasive means, so now we can come back to what kinds of opinion an auditor can give. Okay, so firstly it is the unmodified opinion. Unmodified opinion means clean or unqualified, meaning that there are no material misstatements, or the auditor is giving a reasonable assurance that the financial statements are free from material misstatement, and it is prepared as per the applicable financial reporting framework, right? Next, the second type of opinion is modified. Modified in itself has 4 parts, right? So what are the 4 parts? First is, then obviously in every case there will be material misstatement, right? So modified opinion is when there is, the first part is when there is material misstatement and it is pervasive, we will give an adverse opinion. Okay, so when there is material misstatement and that material misstatement is pervasive, we will give an adverse opinion. Okay, when there is material misstatement but it is not pervasive, we will give a qualified opinion, meaning and we will have to write in the audit report, we will have to provide that what is the basis, why are we giving that qualified report, right? So the basis of qualifications is what we will have to provide. Okay, so basically it is confined to a so here what does it mean by not pervasive? It is confined to a single item, or even though it is a single item, it is okay, let me just write it down, so it is simple to understand. So what is, in this case there is a material misstatement but it is confined to a single item, right? And that single item is not substantial part of FS or the financial statement. And lastly, any disclosure or that disclosure is not fundamental to the understanding of the financial statements, right? But here, however, when you give an adverse opinion, so there is a material misstatement, either it is not a single item, it is not confined to a single item, basically not confined to a single item, or it is confined to a single item and that single item forms a significant part of the financial statements, or lastly, any disclosure is fundamental to the understanding of the financial statements. So that's when we will give an adverse opinion. If it is not pervasive, we will give a qualified opinion. Okay, now next, in cases where the auditor is not able to find sufficient and appropriate evidence, so he's not able to find evidence to provide an assurance, right? He is not able to find the sufficient and appropriate audit evidence to express an opinion. That time he will, if such item, or if he's not able to find evidence about anything, meaning such an item is pervasive, then he will give a disclaimer, right? He will give a disclaimer. If it is not pervasive, then he will give a qualified opinion, meaning only a part of it is materially misstated. Okay, so basically in cases of qualified opinion, meaning in this case and this case, the audit report will have something like the financial statements are prepared in all material respect, are free from material misstatement, and are prepared as per applicable financial reporting framework, except for the basis on which qualification is provided. And then down below they will give basis for qualification, and there they will basically write where the problem is found. Okay, so that is simple, right? Okay, so again let's just recap it once more, okay, in this alternate view, okay, that I've created. Okay, so here basically into 2 parts, one is modified and first one is unmodified and the second one is modified. Okay, so unmodified meaning it is unqualified, or a clean report is given, meaning there is no or he's giving a reasonable assurance that there is no material misstatement and it is prepared as per applicable financial reporting framework. Okay, next, when a modified opinion will be given. Now, first, in the first case, in 2.1, there is material misstatement. Okay, if that material misstatement is pervasive, then we will give an adverse opinion. If that material misstatement is not pervasive, we will give a qualified opinion. Basically, just try to close your eyes and imagine this map. Okay, so firstly, there is it is divided into unmodified and modified. Unmodified meaning there is an unqualified or a clean report that is given, meaning that there is no material misstatement and the financial statements are prepared as per applicable financial reporting framework. Okay, so if there is a misstatement or if there is some inconsistency, the auditor will give a modified opinion. Okay, so modified opinion can be based on two parts again, whether there is material misstatement or whether sufficient and appropriate audit evidence is not found. Okay, so first case, in modified opinion, where there is material misstatement and it is that item is also pervasive, in that case we will give an adverse opinion. Okay, and when there is a misstatement but it is not pervasive, right, there is misstatement but it is not pervasive, we will give qualified opinion. Okay, now in cases where sufficient and appropriate evidence is not found, there, if such an item is pervasive, we will give a disclaimer opinion. Okay, we'll give disclaimer opinion. And if there is no sufficient and audit evidence that is found but it is not pervasive, again we will give a qualified opinion. Okay, right, basically done. Next, we will move on to we'll just see what is given in this material and then we'll move on. Okay, right, or here the types of opinion. Here, this clean opinion or modified opinion. In modified, there can be either qualified opinion, adverse opinion, or disclaimer of opinion. When can you give a qualified opinion? Either there is material misstatement but it is not pervasive, right? It is not pervasive, or there is no evidence, no sufficient and appropriate evidence, and it is again not pervasive, right? Next, adverse opinion is given when material misstatement is there and it is also pervasive. Simple. So it is also pervasive. Material misstatement is also there, pervasiveness is also there. Disclaimer is given when no sufficient and appropriate audit evidence, or no sufficient and appropriate evidence, and it is pervasive. So both it is satisfying, right? Very simple. We will move on. Okay, again, meaning of pervasive, we'll just go through again out here. The term pervasive is used to describe the effect of misstatement. It is used to describe the effect of misstatement. Okay, next, whether the effect of misstatement is pervasive or not is dependent on the auditor's judgment, and auditor's judgment is based on obviously his training, knowledge and experience. Okay, so his training, knowledge and experience is what is used in the auditor's judgment. Okay, however, he has to consider the factors. Okay, the factors determining whether an item is pervasive or not. Okay, so what are those factors? First, it should not confined to a single item, right? Not confined to single item. Next, it is even though it is confined to a single item, it forms a substantial part. It forms a substantial portion or a substantial portion, right? So this is the first case and this is the second case. Now third case is when it comes to disclosures, if such a disclosure is fundamental to the understanding of the financial statements, so it will be considered as pervasive. Okay, next we'll move on to the management. Okay, so here, those charged with governance. Okay, so those charged with governance are the TCWG are those charged with governance. Okay, so they have the responsibility of overseeing strategic direction and obligations related to the accountability. Okay, let us just read from the material itself. One second. Okay, the persons, here it is, the persons or the organization with the responsibility of overseeing strategic direction of the entity and obligations related to the accountability of the entity. Okay, so those charged with governance are the persons or organizations with the responsibility of, first is overseeing strategic directions and other obligations relating to the accountability of the entity. Okay, so it is overseeing strategic directions and obligations related to accountability of the entity. Okay, so the persons or organization with the responsibility of overseeing the strategic direction of and obligations related to the accountability of the entity. Okay, let's just write the limit again without seeing. Okay, so here the persons or organizations with the responsibility of overseeing the strategic directions and obligations, with the obligation related to the accountability of the entity. Okay, simple. Now let's just try the line again. Okay, so the persons or organizations with the responsibility of overseeing the strategic direction and obligations related to the accountability of the entity. Okay, perfect. Next, so here TCWG and management are two separate things. Okay, don't confuse yourself that TCWG and management are the same thing. Okay, so TCWG has this meaning, okay, which is obviously the persons or organizations with responsibility for overseeing the strategic direction of the entity and obligations related to the accountability of the entity. Okay, when it comes to management, the management is the persons with the executive responsibility, meaning they execute, right? They're not overseeing the strategic direction, they're just executing the strategic direction for executive responsibility for the conduct of entities operations. Simple. Okay, next we're coming to a very important topic. What are the preconditions, or also called as the premises for conducting an audit, right? So the first condition is, first you have to determine whether the financial reporting framework that is used is acceptable or not, meaning that if the entity has used maybe some Nepali accounting standard or something which is not acceptable to be used in India, right? We have to use the Indian accounting standards or the normal accounting standards as passed by the IASB, right? So first we have to determine whether the financial reporting framework they have used is acceptable or not. Next, we have to obtain an agreement in writing, right? In writing that the management acknowledges and understands its responsibilities. It has three responsibilities, which is, first is it the preparation and presentation of financial statements, basically for PPFS, right? And then the DIMIC, meaning the design, implementation, maintenance of internal control to ensure, this ensures that the PPFS, the preparation and presentation of financial statements, is free from material misstatement. Okay, so DIMIC, so that PPFS is free from material misstatement. Very simple, right? Next, allow unrestricted access to those whom the auditor determines necessary for obtaining audit evidence. Okay, so firstly in the three responsibilities of the management is to prepare and present in the preparation and presentation of financial statements. Secondly, it is to design, implement, and maintain the internal control uh, to ensure that the preparation presentation of financial statements is as per is free from material misstatement, right? Whether due to fraud or error, right? Next, lastly, allow unrestricted access to the auditor so that he may uh, approach or uh, approach any person that the auditor deems uh, necessary for obtaining audit evidence. Okay, so those are the uh, responsibilities of the management. Okay, so what are the preconditions? So in essence, there are only two preconditions. One is to determine whether the FRF is acceptable, and second is to obtain an agreement stating that the management acknowledges and understands. So it is acknowledges and understands its responsibilities for preparation presentation of financial statements. Secondly, design, implementation, and maintenance of internal controls, so that in order to ensure that the preparation and presentation of financial statements is free from material misstatement, whether due to fraud or error. And lastly, uh, unrestricted access to persons whom the auditor determines necessary for obtaining any audit evidence. Okay, let's just try to tell it without it being on the screen, basically. Okay, so the first thing is FRF must be acceptable. FRF is acceptable. So this is the first condition. Okay, so the next condition is that to get an agreement from management stating two things, right? That it acknowledges and understands its responsibilities. Okay, so what are its responsibilities? First responsibility is preparation and presentation of financial statements. Next is design, implementation, maintenance of internal control to ensure presentation and preparation of financial statements are free from material misstatement, whether due to fraud or error. Okay, and lastly, provide unrestricted access to any person the auditor deems necessary to obtain audit evidence. Okay, clear? So first is that the FRF must be, the financial reporting framework must be acceptable, and then an agreement in writing from the management stating that it acknowledges and understands its responsibilities. What are the responsibilities again? For the preparation presentation of financial statements: design, implementation, maintenance of the internal control to ensure that preparation and presentation of financial statements are free from material misstatement, whether due to fraud or error, and provide unrestricted access to any person the auditor deems necessary to obtain audit evidence. Clear? I think that seems enough for this, right? Next, what is internal control? The process of design, implementation, maintenance by those charged with governance, management, and other personnel. Okay, so it is a process of designing, implementing, and the maintenance of by the TCWG. Okay, let's just dive into the material 1 second. Right. Just see what is given about the preconditions for an auditor here. Okay, so here it determines whether financial reporting framework is acceptable. Okay, determine whether the financial reporting framework is acceptable. Next, obtain an agreement of the management that it acknowledges and understands. So it acknowledges and understands its responsibility for PPFS as per FRF, right? As per AFRF. So it's just, I think it's messing over here, right? So here it is. Here it should be preparation and presentation of financial statement as per AFRF, which is applicable financial reporting framework, right? Applicable financial reporting framework, right? Next, where were we? Here, right? So first is determine whether the financial reporting framework is acceptable, and secondly, obtain an agreement from the management that it acknowledges and understands its responsibilities in PPFS as per AFRF. First is the preparation and presentation of financial statements as per the applicable financial reporting framework, and for the internal control of its management as it considers necessary, and lastly, it provides the auditor access to all information and any additional information and unrestricted access. Okay, so again, I think there are a few words that were left out there, few sentences that were left out. We just do it from here again. Okay, so first is to determine whether FRF is acceptable. FRF is acceptable, right? That's the first one. Second point is agreement. Get an agreement, obtain an agreement from the management stating that it acknowledges and understands its responsibilities, right? What are its responsibilities? First is preparation presentation of financial statements as per AFRF, right? Secondly, design, implementation and maintenance of its internal control as the management deems fit, and lastly, access to information, access to info, right? And second is any additional info that the auditor may require, any additional info, and lastly, unrestricted access to persons, to any person within the entity whom the auditor determines necessary for obtaining audit evidence, right? Perfect. Let's move on. Okay, next, here. Now, what is internal control? Internal control is a process designed, implemented and maintained. DIM, designed, implemented and maintained by those charged with governance or the management or any other personnel to provide reasonable assurance, as to the, we just have to remember, reliability, effectiveness and efficiency, safeguarding, and lastly, compliance. Okay, so here reliability as to the financial reporting, effectiveness and efficiency of the operations, safeguarding of the assets, and lastly, compliance with laws and regulation. Okay, let's just remove that and let's try to write it again. So what is internal control? Internal control is a process designed, implemented and maintained by those charged with governance, the management or any other personnel, right? To provide reasonable assurance, right? To provide reasonable assurance with regard to, okay, it provides reasonable assurance with regard to four things, right? So firstly, with regard to reliability, right? Reliability, forgot about it for a second. Reliability, and then reliability of what? The financial reporting. Next is, as to the reliability of financial reporting, safeguarding of assets, and then efficiency, effectiveness and efficiency, right? Effectiveness and efficiency of operations, and lastly compliance with laws and regulation. Okay, let's just take a recap of this entire thing once again. Okay, so what is internal control? Internal control is the process designed, implemented and maintained by those charged with governance, the management or any other personnel, right, to ensure or to provide reasonable assurance with regard to reliability, effectiveness and efficiency, safeguarding, lastly compliance. Okay, reliability as to the financial reporting, effectiveness and efficiency of the operations, safeguarding of the assets, and compliance with laws and regulation. Okay, simple. Next we'll move on. Okay, next, test checking. Test checking is another word for sampling. Okay, sampling means application of audit procedures to less than 100% of the transaction. Okay, it is also known as sampling. Okay, so application of audit procedures to less than 100% of the transactions. Right, simple. Next, what does judgment mean? Judgment here it means professional judgment. Right? Professional judgment. Right? The application of relevant training, knowledge and experience in making informed decisions, right? In making informed decisions about the course of actions that are appropriate in the circumstance. Okay, application of is the application of relevant training, knowledge and experience in making informed decisions about the course of actions that are appropriate in the circumstance. Right? Next. The framework of conducting an audit. Right. First is you have to engage or appoint an auditor. Next comes the planning stage, the audit planning, setting of materiality and application of risk assessment. Right. So this risk assessment is done through risk assessment procedures, called as a RAP, and then the response to the risk. So response to the assess risk through FAP or the further audit procedures. So this further audit procedures is of two types. First is a test of controls and substantive procedures. So substantive procedure is also of two types. So here substantive audit procedures or test of detail. Okay. Next, and then the collection of audit evidence, conclusion, opinion and reporting, and then the audit documentation. So it's not a particular order, because all of these are to be done continuously through the process of the audit, right? So planning is always done throughout the process of the audit. Documentation is also done throughout the process of the audit. Audit evidence is also collected throughout the process of the audit, right? So it's not like a step by step procedures for audit, but it is just a method. Like it's just what are the elements or what are the things that are in the conduct of an audit. But we can remember it in order itself, right? So first is engagement of an auditor, right? Engagement of auditor. Second one is we start off with planning stage, planning. Next is materiality, right? Risk assessment. Next we assess the risk, right? after assessing the risk, we respond to the risk. Response to risk, right? And after that, audit evidence. We collect the audit evidence. Based on this audit evidence, we come to a conclusion. On that conclusion, we reach an opinion, and based on that opinion, we will make a report. And of all these things, we will make the audit documentation. Perfect. Okay, so basically that is the framework to conduct an audit. Okay, next, moving on to the risk assessment procedures. I think we have okay. So what is risk assessment? Risk assessment is the process of assessing ROMM. ROMM is risk of material misstatement. Okay, so through risk assessment procedures, we assess ROMM. Okay, so what is ROMM again? What is risk of material misstatement? It is that risk that the financial statements are materially misstated prior to an audit. Okay, okay, clear? So it is the risk that financial statements are materially misstated prior to an audit. Okay, next. Now, what is risk assessment procedures? Risk assessment procedures are those procedures that are used to identify and assess risk of material misstatement. Okay, so RAP is used to identify and assess ROMM. Okay, it is used to identify and assess ROMM. Okay, it is also used to obtain understanding of the entity and its environment, including its internal contour, in order to assess ROMM and determine the nature, timing and extent of further audit procedures. Okay, so basically here we had come to risk assessment, right? So we just recap the entire thing that we have seen till now. Okay, so firstly, an audit is a independent examination of the financial, I'll just right click this. Okay, audit is an independent examination of the financial statements of any entity, right? Any entity, irrespective whether profit oriented or not, irrespective of size or legal form. Okay, with a view to expressing an opinion thereon. Okay, next, and then we saw the objectives of an audit. What are the objectives of an audit? Where does this objectives of an auditor come from? Objectives of auditor, where does it come from? It comes from SA 200. SA 200 is overall objectives of an independent auditor and conduct of audit as per standards on auditing. Okay, so what does SA 210? It asks us to obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. And secondly, it asks us to express an opinion that financial statements are prepared in all material respects, are prepared as per AFRF, right, as per applicable financial reporting framework. And lastly, to report on the financial statements and to pass an opinion, and to communicate as per relevant essays, Okay, right? And then we saw the types of opinions. We saw they can be unmodified or modified. Even in modified, there can be two subdivisions, which is whether that modified opinion is being given due to material misstatement, or whether sufficient appropriate evidence is not found. Right? Even in material misstatement there are two parts, whether it is pervasive. If it is pervasive, then we will give a adverse opinion. Okay, if it is not pervasive, we will give a qualified opinion. Okay, here again, if it is pervasive, then we will give disclaimer. If it is not pervasive, we will give a qualified opinion. If it is we will give an unmodified opinion when there is no material misstatement, or there is reasonable assurance that there is no material misstatement. Okay, here we give an unqualified opinion. Okay, next we saw what pervasive means, right? Pervasive describes the effect of misstatement. Okay, effect of misstatement, right? So what is how do we check whether it is pervasive or not? Firstly, as I told, we check the effect of misstatement. So it is based on the effect of misstatement, right? Next, it is based on pervasiveness, whether an item is pervasive or not. It is based on auditor's judgment. His judgment is, and he makes these judgment based on his training, knowledge and experience, right? And then lastly, the factors that the auditor needs to consider. Factors to be considered. What are the factors that are to be considered? So there are basically three factors that need to be considered. Firstly, whether it is confined to a single item. Not confined, basically it is not confined to single item. It is pervasive when it is not confined to a single item, right? And then even if it is single, but forms substantial portion of the financial statements, it is considered as pervasive. And when it comes to disclosure, whether it will be considered pervasive if such disclosure is fundamental for understanding of the financial statements. Perfect. Okay, next, I think I forgot something in between. Pervasiveness, and then we saw yes, the TCWG. We came towards the what is TCWG? TCWG are those charged governance. So basically we saw that the persons or organizations responsible, right, or persons or organizations with the responsibility of overseeing the strategic direction and obligations related to the accountability of the entity. Okay, so this is TCWG. Next, management. What is management? Management is the persons charged with executive responsibility. Okay, meaning they only execute, they don't plan, so they are only with the executive responsibility, right? Next, after this, what did we see after TCWG? We saw the preconditions, right? So what are the preconditions again? So there are only two preconditions. So when it comes to preconditions, right? So preconditions are, firstly, the FRF, meaning the financial reporting framework, should be acceptable, right? Should be acceptable, right? And the next one is, we need to obtain an agreement in obtaining an agreement from the management, right? We have to obtain an agreement from the management stating that the management acknowledges and understands its responsibilities. Okay, so what are its responsibilities? There are three responsibilities, right? So the first responsibility of the management is to preparation and presentation of financial statements as per applicable financial reporting framework, right? Next is design, implementation and maintenance of internal control to ensure presentation preparation of financial statements are free from material misstatement. And lastly, access to information such as for example records or journals or ledgers, right? For access to information, any additional information, right? So any additional information that the auditor requires. And lastly, unrestricted access to any person within the organization the auditor deems necessary to obtain audit evidence. Okay, next, so that is a quick revision of the things. Oh, again the internal control also, right? We just can. Okay, so here what is in we just cover this also. So the internal control is the process designed, implemented and maintained by TCWG or those charged with governance, the management or any other personnel to ensure reliability, effectiveness and efficiency, and then safeguarding and lastly compliance. Okay, so here reliability as reliability of the financial reporting, effectiveness and efficiency of the operations, and lastly safeguarding of the assets and compliance with laws and regulations. Okay, so that is the meaning of internal control. Okay, so here a few things that are extra is the auditor is concerned only with the internal control related to the financial statements. Okay, okay, so internal control can relate to anything. It could be linked to the financial information or non-financial information. So auditor here is concerned only with the internal control related to the financial statements. Okay, so generally the auditor is not required to give an opinion on the internal control. However, if there is any he has to give the opinion if required by any law or regulation. Okay, so unless he is required by law or regulation, he is not required to give an opinion. Okay, however, the auditor is within his rights to point out weaknesses and suggest improvements in internal control. Okay, but he is not required to give an opinion unless required by any law or regulation, and the auditor can point out any weakness or suggest any improvement in the internal control. Okay, perfect. Let's move on. Okay, so here why we had come to a stop is just to give a quick summary of whatever we had discussed till now, right? So what is the framework for audit, right? Okay, so first is the engagement. Okay, next is planning, next is materiality. Now coming to risk assessment procedures or the risk assessment. So now what is risk assessment? Assessment is to as we had seen here, risk assessment is the process of assessing ROMM. Okay, it is the process of assessing ROMM. What is ROMM? ROMM is the risk that the financial statements are materially misstated prior to audit. Okay, so the risk that the financial statements are materially misstated prior to audit. Okay, so to assess ROMM, we to assess the ROMM we use risk assessment procedures, which are RAM, which is also called as RAM. Okay, it is used to identify and assess risk of material misstatement. It is also used to obtain an understanding of the entity and its environment, including internal control, in order to assess ROMM and determine the nature, timing, and extent of further audit procedures. Okay, so where were we? I had to go, right? So just to recap, right? So here the risk assessment is done through risk assessment procedures. Okay, so risk assessment procedures is used to identify and assess ROMM. Okay, so which is risk of material misstatement. What does risk of material misstatement mean? Risk of material misstatement means the risk that the financial statements are materially misstated prior to audit. Okay, so these risk assessment procedures are also done to obtain an understanding of the entity and its environment. Okay, and also in order to those risk assessment procedures are also used to assess the ROMM and determine the nature, timing, and extent of further audit procedures. Okay, let's just revise that again. So here, risk assessment procedures are used to identify and assess risk of material misstatement, right? So what is risk of material misstatement? It is the risk that financial statements are materially misstated prior to audit. Okay, so it is materially misstated prior to an audit. Okay, it is also used to obtain an understanding of the entity and its environment. Okay, entity and its environment, in order to assess ROMM and determine the nature, timing, and extent of further audit procedures. Okay, so that is simple, right? Okay, so here risk assessment procedures do not alone provide audit evidence, meaning you cannot conclude an audit or provide an opinion on the financial statements by doing only the risk assessment procedures, right? So you have to do risk assessment procedures only help you assess the risk of material misstatement and help you gain an understanding of the entity, but it is not enough to provide an opinion on the financial statements just by doing the risk assessment procedures. Okay, let's move on to the audit risk. Okay, so audit risk is of two types. Okay, so audit risk is there is risk of material misstatement, which is this is prior to audit. Okay, prior to audit, right? And then detection risk, meaning that the risk that a material misstatement will not be found, even though the auditor has applied the substantive audit procedures. Okay, so even though he has put substantive procedures, it is still not being detected. Okay, so that is the detection risk. Okay, next. So in audit risk, obviously again there are two parts, that is the risk of material misstatement and detection risk. And in risk of material misstatement there are further two parts, which is the inherent risk. Inherent risk is there is a risk of material misstatement due to the nature and characteristic of that item in the financial statements. Okay, and control risk. Control risk is a risk where the risk of material misstatement, even though there is internal controls that are applied in it. Okay, here in case of Roman, okay, in case of risk of material misstatement, in audit risk, in case of material misstatement, auditor can only identify and assess it. Okay, but he cannot increase or decrease, he cannot change this. Okay, he can only identify and assess what the risk of material misstatement is. Okay, next. Here now, after doing the risk assessment procedures and identifying and assessing the risk of material misstatement, the auditor will respond. He will respond with the further audit procedures. Okay, so he will either do a test of control or he will go through substantive procedures. The substantive audit procedures include test of details and the substantive analytical procedures. What is the substantive analytical procedures? It includes of various different procedures, analytical procedures, like such as comparing financial and non-financial data and finding out whether there is any inconsistency, right? So that's simple. Okay, let's just recap over here from the beginning. So after doing risk assessment procedures, the auditor will identify and assess the risk of material misstatement, and then he will respond through further audit procedure. Further audit procedure is of two types, which is test of control or substantive procedures. Substantive procedures also of two types. One is test of details and substantive audit procedures, analytical procedures, right? So here test of control is to assure that his initial understanding of the internal control is correct. Okay, here he has relied on the internal control, thinking that the internal control is high. Okay, meaning that there is a good internal control system that is placed, right? So initially he would have assumed this, and to ensure that this initial assumption or his initial understanding that the IC is strong is correct. Okay, so he will check the design, right? So he will check the design. If the design is good, he will test the efficiency of that system. Okay, if the design is bad, he will move to substantive procedures, meaning he will jump to this ship. Okay, he will not rely on the controls anymore, he won't test the controls, he will shift it to the substantive procedures basically. Okay, next, let's just recap from the top again. Okay, so first he will perform the risk assessment procedures, or the RAP, to identify and assess the risk of material misstatement. Okay, first he will apply the risk assessment procedure to identify and assess the risk of material misstatement, and then in response to the risk that he has assessed, he will move to further audit procedures. The further audit procedures are of two types: test of control and substantive procedures. In test of controls, he will do these test of controls to ensure that his initial understanding is correct. So his initial understanding of the internal control is correct, and he will check the design. If the design is good, okay, basically how he will check the design is through SOD, meaning segregation of duties, through whether any approval systems are there, meaning if any particular action has to be approved through multiple layers of security, and he will do reconciliations to check whether there are whether all these are being done, right? So if it is good, if the design is good, he will test the efficiency, meaning he will test the controls, whether controls are good or not. Like, he will just test the controls, right? And he will reduce the substantive procedures, right? But if the design is bad, he will not test any efficiency. Why should he waste time doing the test of control when he can just jump into substantive procedures? Like, he will have to check so many again. Why will he sit and check the control of the firm or the organization, right? So if the design is good, he will test the efficiency of uh, the controls or the control system. If the design is bad, he will start the substantive procedures, right? Moving on. Substantive procedures are of two types again: test of details and the substantive analytical procedures. Just move on to this again. Okay, so how will the auditor do substantive procedures, or the test of details and the test of or the substantive analytical procedures? So basically, there are assertions. What are assertions? Assertions are representations of the management. Okay, so representation of management. Okay, so assertions are also of three types. First is of account balances. Next is of the transactions, and lastly, presentation disclosure. Okay, so account balances through ERCV. Okay, please do not keep saying ERCV without telling the full forms. So here, E is existence, R for so you'll check its existence, right? And you will check its rights and obligations. You will check the completeness and its valuation. Okay, so in the balance sheet or in the financial statement, they're showing a building, right? So they're showing a building, let's say of 50 lakhs. Okay, so whether this building actually exists, forms part of this E right here, or this E, whether it exists, and whether there is actually a right on that particular asset that exists. That is checked through the title deeds and everything. So that is checking the rights and obligations and the completeness, whether there is any other building that has been omitted, or whether there is any detail that is missed, right? So that is through completeness. And lastly, the valuation, whether this amount is actually correct or not. Okay, so that is checked through ERCV, which is existence, rights and obligations, completeness and valuation. Okay, so when it comes to transactions, we check the OCACC. Okay, so the occurrence of the transaction, whether the transaction actually occurred, and secondly, let's just go to this one. So whether that transaction actually occurred, whether it is completely recorded, whether there are any omissions, or whether there's any amount that is missing, whether that amount is complete, right? Next is accuracy of the amount, and the cutoff meaning whether it is recorded in the relevant period. Okay, here it's not only period, it's the relevant period. And lastly, whether the classification is proper, whether it should have been classified as an income, or whether it should be classified as an expense, or whether it is a long term or short term, right? So basically all those classifications are seen. Lastly, when it comes to presentation and disclosure, we see whether the obligations and rights are presented, whether it is disclosed, presentation is complete, whether the classification is correct in the presentation, and the valuation is correct in the presentation. Basically it. Okay, so let's just recap from the top here again, from the top. Okay, so when it comes to framework of an audit, so firstly, engagement of an auditor. Next is planning, materiality, risk assessment. In risk assessment, what do we do in risk assessment? We assess ROMUM. Right? We assess ROMUM. ROMUM is material misstatement. What is ROMUM? the risk of financial statement being materially misstated, whether due to fraud or error, prior to the audit. Okay, next, how do we assess that? We use risk assessment procedures to assess the risk. So firstly, risk assessment procedures are used to identify and assess the ROMM. Okay, it is used to identify and assess the ROMM. Okay, and it is also used to obtain an understanding of the entity and its environment, right? Entity and its environment. Okay, and including its internal controls, in order to assess ROMM and determine nature, timing, and extent of further audit procedures. Okay, now further audit procedures are of two types. It can be a test of control or substantive procedures. In substantive procedure, it can be a test of detail or substantive analytical procedures. Right. Okay, I think we'll just stop it here and then we'll continue in the next part.